So let's discuss on CANSLIM. Basically, this whole CANSLIM strategy is based on result of lot of analytics. So it was initiated by Mr. Bill O'Neill or William O'Neill. So what he did was that he analyzed the top 50 performing stocks and then found out what are the common characteristics of those 50 common stocks. Then he went on further and then analyzed top 100 stocks. And then he again tried to find out what is the common parameter of best performing top 100 stocks. And then he was expert of analyzing the database. At that specific time, he had a lot of tools to analyze. He had a huge team to analyze the data and find out what is the common parameter for a stock to perform. And he did it over and over multiple years. And he found out that these 7 characteristics are responsible for a stock to perform. These 7 characteristics were common in all the stocks. So the first parameter was current earning. A stock is very much driven by the earning. You might see in multiple news channels that they discuss that this particular stock is going to perform because it has posted a recent good earning. So he has found this a common criteria in all good performing stocks or the best performing stocks. Best performing means that those stocks have advanced a lot in lesser time. Best performing stocks are those which has given a lot of gain in less amount of time, which has grown a lot from, let's say, a few dollars to 10 times or 5 times of the initial price in very small duration. So he found out that all the stocks which has performed really well in terms of price had recent earning to be better than the previous earnings, and that too is at least 25% up compared to the same quarter of the previous year. What does that mean? That means if we are at December and the September quarter result is out so far, so whatever recent September result we are able to see, that September 2024 result should be 25% more than September 2023 result. So the same quarter, corresponding quarter of the previous year, the earnings should go at least above 20%. The company should have earned at least 20% more compared to the previous year same quarter. Now the second point which he found out is common in all the outperforming stock is annual earning growth. So that also the whole year earning should be better than the previous year earning. The yearly earning is posted in March. So the March to March earning of this particular year should be better at least by 25%. And also return of equity of 17% is also favorable. So the current earning and the yearly earning both should be better than the previous year by 25%. And the third point he noticed is common in all well-performing stock is the new product, services or leadership. So when a company introduces a new product, and if a product is revolutionary, that helps a company to grow. So if, if an innovative product has been introduced or an innovative service has been introduced, that helps to trigger a good earning later on and then result to the good price or growing price of the stock. Now, the third point he noticed is that during an uptrend, the volume should be good, the demand should be high, and the supply should be lesser. So that analysis should also be done through price action, that during an uptrend, the price is going up with a higher volume. That means there are more buyers getting into the share, which also indicates more of bigger player or institution are interested, because you see during buying there is huge amount of volume. So the analysis of supply and demand with respect to the volume and price also has to be done. So the stocks which are going up with the higher volume are the better performing stocks. That's what he has found out with all his analysis. Along with that, the leaders in the market, the stocks which are outperforming the overall index, continue to outperform. So their relative strength should be higher. What do I mean by relative strength? That means in the last year, if let's say S&P has grown, S&P has went up to 20%, the stock should go more than 20% up. Related to the index, the stock price should grow more. That indicates there is more interest in the company by investors. So it should relatively go higher compared to the index. So mostly the outperforming stocks are leaders. Now, the sixth point is institutional sponsorship. If institutions have more ownership over the stock, that suggests there is something good fundamentally with the stock. And in that case, the stocks tend to perform better. This is a reverse study. You have studied a whole bunch of best performing stocks and found out common criteria. Also, market direction is important, because if market is down, the stocks might not perform. It has been observed that 3 out of 4 stocks goes along with the direction of the market. So if market is falling, 75% of the stocks would fall. And in that case, you will see a lot of drawdown. So we should always enter into the market with the strength of the market, not with the weakness of the market. Gone are the thoughts that we should buy stocks when market is falling. We should buy stocks when market is going up. So these were the common criteria which have been found out with a lot of analytics. And also, always the CANSLIM stocks has outperformed the index performance by 3 times or 4 times. It can be seen in multiple analytical tools. I myself have backtested with the Nifty. The CANSLIM performed 2.5 times more than Nifty. And over the period of many years, it has been tested on multiple platforms that it outperforms the index by 3 times or at least 2.5 times. So odds are already in your favor. If you are better than the index already just buying these stocks, then money management and other aspects becomes really, really easy because odds are already in your favor. We would discuss the technical aspect of supply and demand and rest in the upcoming sessions.